Hello, friends, and welcome to Cafe Mutual YouTube channel. Friends, the last year has been quite eventful for the equity markets. It witnessed heightened volatility and ended with decent numbers this year. But what would happen to equity markets in 2026? What will be the triggers and risk in the coming year? To address these questions, today we have with us Rajesh Jayaraman, Head Product Management at Nippon India Mutual Fund. Rajesh has over 2 decades of experience in AMC and banking business. So let's hear from him about equity markets. Welcome to the show, Rajesh.
Thanks, Nishant. Always a pleasure.
Great, great. So, Rajesh, if you want to define, if you want to point out some defining movement of the equity market in 2025, what would it be?
So 2025, as you rightly said, has been a roller coaster kind of ride. So while a lot of people might say equities per se, normally when we say market, it's largely to do with equity markets. Equity markets wouldn't have been so rewarding, especially when you talk from a Indian context. But from a event point of view, there has been a lot more events which happened, not only globally, but even domestically, we have seen a lot of developments happening, largely policy related. So interest rate cuts happening, GST cuts happening, government trying to shore up the middle income groups by giving them taxation rebates. So all that happened during the year.
Hmm,
And why I say it's an interesting year, because a lot of people would have actually been not so happy with the returns what they got from equities. But people who have been there in the markets, or have been at least reading, hearing about markets for some period of time, typically would have seen market goes through this kind of cycles.
hmm,
And this has been that year where we have seen again a divergence. Not only that India diverged from other major global markets, with the performance being quite muted in India when a lot of the other global markets did well,
hmm,
but even within the market cap segments, you could see a big divergence between your large caps and the mid and small caps.
hmm,
More importantly, even within these individual segments, the market breadth actually became narrow. So in that sense, it's been a fairly roller coaster year.
hmm,
But slightly long answer to your question. The fact is, we believe it is actually creating a base. So from where the next leg of growth can be shaped.
hmm,
And why we are saying so, while you said some interesting pointers, but I think to keep the feet on the ground, what is interesting is we have seen a lot of disappointments in terms of corporate earnings happening quarter on quarter. But finally, we're seeing a base getting formed. So we're not saying everything is hunky dory, but at least probably the worst seemingly is we are very close to the bottom of the worst. We don't know if we are exactly at the bottom, but we are very close to it. So it's creating a base. So we look forward to 2026 and the years ahead with a lot more optimism,
hmm,
probably than what we started the year.
hmm. But Rajesh, markets have not seen any significant correction over the last 5 years. So, which is very unusual. Despite events such as Trump-related development and ongoing geopolitical tensions, market have remained resilient. So, what accounts for this resilience in Indian markets?
I think the answer, I think all of us know, because all of us have, in a way, contributed to this stability in the markets. So
Mm,
post-COVID, we have seen a huge shift in terms of the investor preferences. So a lot of domestic investors have turned to equities, given
mm,
the relative attractiveness, or maybe it's because the lure of returns which people saw, whatever the case may be. And we could see that with SIPs now, accounting for such a large flows, mutual fund SIPs, and generally the investor interest in terms of equities have gone up significantly. So
mm,
even when this last 5 years we have seen FPI flows or the foreign portfolio investments being negative, we have seen domestic investors more than making up for it. So that's been a phenomenal kind of shift. Today, if you see the holdings of domestic investors, which is beyond the normal promoter holdings, domestic investors have become the second largest group ahead of the FPIs.
mm,
So, which tells you that today the entire support of the market is coming from the domestic investors. So that's been one of the biggest reasons why Indian markets have been resilient in the last 5 years. It also explains to you why we have not seen any sharp correction in the markets. We did witness 2022, where a very flat year happened. 2025 is largely going to be a flattish kind of year, at least as things we look into today. So we have seen years when the returns have been little less, but no big corrections happened because there has been a lot more support coming into the market, especially from the domestic investor flows, which is happening. Having said that, all of us understand this is just the start, and we are still miles behind some of the large developed economies of the world when it comes to the penetration or the investments on the equity side. So it's still a long way to go, but that's been a huge shift in terms of how people look at equity as an asset class. And that's played a very, very big role in this particular market scenario.
Great, great response, Rajesh. So my next question is that what do you expect from equity markets in 2026, and what could be the major triggers in the coming year?
Sure. So again, a very interesting question, and something which we also keep asking ourselves internally: what went wrong in
Hmm.
2024, at least since end of September 24 till now? What went wrong with our markets, and why we have seen the kind of muted returns, especially in the global landscape, where most of the other markets, from US to Germany to Korea to Japan to Taiwan, had seen reasonably good equity market returns. So some of the challenges, which is quite well documented, as I mentioned earlier, we think we are getting behind them. A lot of policy support which has come in this particular year, that the real effect always happens with a lag. So what probably we endured in 2025 was the ill effects of 2024, to be honest with you, or whatever are the excesses of 2024 that played out in 2025 being a fairly muted year for markets. So we think some of the positive developments which has happened in 2025, especially from the policy support, trying to get the consumption back, trying to get the capex machine again going, all that positive effect could happen with a lag, and possibly 26, 27 is when you will be able to reap some of the benefits out of it. So, which is where the optimism starts with. Secondly, when we look at the global landscape, and one common thing which I'm sure people keep talking about is India is fairly expensive. Indian markets are very expensive. Look at historical averages. We are trading at a premium bid, mid cap, small cap, large cap. We are possibly equal to the 10-year average and everything. And especially from a global landscape, we say India within emerging market space is relatively more expensive.
Hmm.
But if you look at the data now, it tells you India has started to go down below its historical averages. So we're not cheap, but our premiums have come down. For example, our premiums used to be close to 80 same time, or September 2024. Today we're about in the 50s, and the
Hmm.
average is about 65. So it clearly tells you that our premiums are down from the historical averages. So as the views change, and probably some of the global headwinds, which is primarily the tariff part, which is still uncertain, once something fructifies on that front, we think the lens of the foreign investors toward India will also change.
Hmm.
And there could be better allocations going forward. That could be one more driver, which today we are not really expecting too much out of it, but it can happen. It can potentially happen. Second is, after almost 8 quarters of relatively poor earnings in the market, we think we are finally getting to a base, and hopefully, with all the policy support playing out, this should start to trend, improve, and possibly early double-digit kind of numbers is what we estimate is possible going forward. So all that will start to get to play in the markets, and that should help revive the equity market sentiment and the return potential of the underlying asset class.
Got it, got it. But how comfortable are you with the current valuation?
That's the very, very interesting point. So, which is why I'm saying the market this year has been one of the trends in the market, to be honest, has been the narrow market, which we have seen. So, optically, when we look at the market, it seems like the market has been almost flattish, nothing, not too much of correction has happened. But when you scratch beneath the surface, interestingly, you see there are many businesses, many companies, many stocks which have corrected 30, 40, 50% from their peaks. Obviously, there are few which have done even better than that. But I'm saying a good amount of opportunities available in the market. It's not an easy market, to be honest. It's unlike a post-COVID kind of market where it didn't matter where you invested, you still made returns. It is going to be more selective market. In fact, we tell our stakeholders that probably this is a time which is actually fairly good from a active portfolio manager's point of view, because this is when the bottom up stock selection will get rewarded, because here you can't really just pick up one macro theme and run with that. It's going to be which businesses you want to identify within that particular theme, and that's where your skill sets will get tested. It also presents you an opportunity. Just to give some examples so that people can relate to what I'm saying, 2018 to early 20, we had seen a market being very, very narrow, where just few 10 stocks used to get all the returns and the rest of them actually used to struggle. Correct. And then the turnaround happened. So we're not saying we are 18, 19 like narrow markets, but we had some kind of narrow markets. So usually these kind of situations is where the opportunities get created, where you can identify potential winners for the next few years. And we are possibly in that kind of a scenario today. So valuations is one part, but we think the opportunity is also there. So it's not a cheap market, to be honest with you. Optically, the numbers will look at everything will tell you we're at a premium. So mid cap is at maybe 15-20% premium to the historical averages. Small cap still continues to be at premium despite the impacts at an individual stock level. But beyond that headline numbers, there are reasonable opportunities. So there are reasonable. So I think we should mention the word reasonable because unfortunately people believe equities means always bombastic kind of return. That's not the case. But you can get reasonable opportunities in this kinds of market.
Great, great. Good to know. So, Rajesh, which categories of equity funds should MFDs recommend to investors in 2026?
Sure. So one thing about mutual funds is it's quite boring, to be honest with you. So if somebody wants to make money with mutual funds, then they need to the simple things which we say, you stay invested for long term, you do your asset allocation properly, take appropriate risk. So hence the recommendation don't really change from that perspective. But given the context where we are in today in terms of market, so probably had we had this conversation a year back, we would have possibly told you look at large caps because given the risk reward scenario, large caps seem to be much better placed in 2024. Today, probably because of the opportunities which I was mentioning to in the earlier response, we think a more diversified strategy, be it large cap, large and mid cap, a multi cap, or a flexi cap kind of strategies can be better off because you'll get a blend of the you can see the top end companies as well as some of the fast growing companies which can actually benefit as and when this turnaround happens and the view shifts. So that's where we would be more towards the broader kind of strategies, the multis, the flexis, and the large and mid cap kind of strategies is where we think the opportunities lie from an equity point of view. But then obviously hybrids have seen a lot of appetite, a lot of interest from investors in the last few years. So that continues to be there. And hybrid again is something which you try to mitigate the risk by diversifying across multiple asset classes or managing your equity allocation dynamically. So there are two varieties of hybrids at a very broad level, which people continue to look at. So we think that continues to offer interesting opportunities. So somebody who is more conservative, slightly doesn't have the risk appetite, then hybrids fit in. Otherwise, somebody says, no, I have a 5 year view, 10-year view, I want to try and create wealth for myself. Then there's nothing stops them from going into equity funds. But preference today would be more towards the multi and the flexi kind of strategy and the large and mid cap. SIPs in small caps, wonderful. People can continue because India story is not dead for sure. There is still a lot more opportunities which can emanate in the next 5 to 10 years, and nothing captures is better than the mid and small cap. But SIP is a better way to participate there because the next few months, again, the uncertainty, especially the global overhang, still continues. So it can remain volatile. So SIP is a better way to play there.
Okay, Rajesh, one last question. So, since you had the product at Nippon India Mutual Fund, so what goes into the science of product development?
Sure. So honestly, product development, I think, is a very interesting word. But the fact is, what are you trying to give to your investors, correct? The idea is to give real value-added differential kind of products when you do a new product development. Otherwise, it's more of maintenance and regular communication to ensure that whatever you have, which you're offering today, is that being taken in the right spirit by the end stakeholder through the partners, to the distributor, through to the client. So that's one big effort which goes into product development. Again, is trying to see can we offer something more differentiated because we are seeing a lot more sophisticated investors coming into the mutual fund space today. So which is why the category like SIF is getting created and there are other alternatives also which is getting created where you can try and give something more differential than the normal regular kind of products. So our effort and endeavor here, Nishant, is to try and see if we can offer something very differentiated. In fact, the last 5 years, I think we would have done about only five NFOs on the active space. So it tells you that we are very selective as long as we think there is a theme where we can offer something differentiated, something which can probably a theme which is a theme for tomorrow, but we think there are opportunities from today which we can capture. We will come out with that, which is why we launched an innovation fund in the past. Similarly, we think there could be some interesting developments which can keep happening around various things. So today, for example, India doesn't have so much of an AI in the listed space. But if say a year down the line, 2 years down the line, if we see great opportunities there, why not have a fund which can focus on that? Why don't we look at real estate as a space at some point of time, correct? Today there's not too many optionalities to invest. Maybe tomorrow some instruments will come in. So all this is something which keeps going in our discussions. So the idea is to try and offer only something which merits and something which is differentiated. The first point of call is for doing any product, new product development in that matter. Is this going to really benefit the investor? And can are we offering something substantially different? Or is it just that we're trying to use this as an asset garnering machine? If it's point number three, then obviously it's a cross for us. The first 2 points is where the debate happens. And if it qualifies, then we come out with the ideas then.
All right. Thank you so much, Rajesh, for your valuable time and input. You have made equity investing very simple for distributors, and you have given a lot of food for thought to distributors. Thank you so much, Rajesh, for this.
Thanks. Pleasure, Nishant. Pleasure speaking to you. Thank you.
And finally, I thank each one of you for being such a wonderful audience. Have a lovely day at work, guys. Thank you.